Right. So today, we're diving deep, and we're going into chapter 15.
Oh, okay.
Nothing's free. It's from Morgan Housel's The Psychology of Money.
Oh, yeah.
That book that kind of unpacks how our minds can really mess with our money decisions, you know? And get this, Housel uses like the epic rise and fall of GE
Right.
to show how even like these big industry leaders, they could fall into that trap of thinking they can get something for nothing.
Yeah, it's really a classic example of how something can look so easy from the outside.
Right.
But then you get in the driver's seat, and it's a whole different ballgame. It's way more complex and way more costly than you ever imagined.
Yeah, and it makes me think of that quote by Jeff Immelt,
Yes.
who is the CEO. He said, every job looks easy when you're not the one doing it.
Oof. Yeah.
Which, I mean, talk about foreshadowing, right?
Yeah.
Like, here's GE in 2004,
Right.
the world's biggest company.
Right.
Worth $1/3 trillion.
$1/3 trillion.
Everyone's looking at them like, these guys are geniuses.
Exactly.
But fast forward like a decade, and it's a completely different story.
Completely different story.
What happened there?
Well, on the surface, it seemed like Immelt was playing the game, right?
Okay.
But, and this is where House is so insightful, his strategies, which seem so successful, they had these hidden costs, that were like ticking time bombs.
So it's like those home renovation shows where they're all excited, like we save so much money doing it ourselves.
Right.
But then like 5 years later, the whole thing is falling apart.
Exactly. And in GE's case, the 2008 financial crisis really exposed those hidden costs.
Oh, okay.
Their financing division, which had been like this huge profit center, it suddenly became a liability and they had to sell it off.
Oh, wow.
For pennies on the dollar. And then there were those huge bets they made on oil and energy.
Yeah.
Right when the world was starting to shift away from fossil fuels.
Oh.
Talk about bad timing.
So basically, they were racking up all this debt, not just in terms of actual money, but like consequences they couldn't even see yet.
Yeah.
And eventually the bill came due. Man, that's got to hurt.
It does. It's a stark reminder that every decision we make, whether it's a business strategy or, picking stocks for our portfolio, it has a trade-off.
Right.
There's always a price to pay, even if we don't see it right away.
Okay, so how does this whole nothing's free idea apply to like us, everyday investors? I mean, we all want those big market returns, right?
Absolutely. And historically speaking, investing in something like the S&P 500 over the long term, it really does pay off. We're talking 119-fold growth over the 50 years ending in 2018.
Wow, 119-fold. That's incredible. But come on, what's the catch?
The catch, my friend, is that entry ticket to this wealth building party. Volatility.
Mm-hmm.
It's the ups and downs, the roller coaster you've got to be willing to ride to reach those gains.
So it's not all sunshine and rainbows in the stock market? Shocking. But really, what does this volatility actually look like?
Okay, imagine you've got your S&P 500 chart.
Got it.
Over time, it's clearly trending upwards.
Okay.
But you zoom in and you see all these dips and crashes, these times where the market takes a nosedive. You see those shaded areas on the chart, right?
Yeah. Got my chart pulled up right here. And you know what? It is a lot more red than I'd like to admit.
It's a reality check for a lot of folks. Housel uses the Dow Jones Industrial Average going all the way back to 1950. It averaged an impressive 11% return per year over those decades. But get this, for a huge chunk of that time, it was actually trading more than 5%.
Wow.
Below its previous all-time high.
Wait, so even with those amazing average returns, you're saying it spent a big chunk of time in the red?
Yeah.
Huh.
And it's not just ancient history. Look at Netflix, phenomenal returns. But over its entire lifetime as a public company, Netflix traded below its previous high point a mind-boggling 95% of the time.
95%. So basically, even with a winner like Netflix, you're more likely to see it down than up on any given day. That's going to be a tough pill to swallow for people who want to get rich quick.
It is. And what makes it even harder is the psychology of it all. It's human nature to want to avoid those dips, to try to outsmart the market and grab those gains without feeling the pain.
So that whole buy low, sell high mantra, is that even realistic?
That's where things get really interesting because just like in life, trying to dodge the price in investing can often lead to even bigger costs down the road.
Ooh. I like where this is going. Tell me more about that. How does avoiding this volatility, this cost, backfire?
Well, Housel uses this analogy of car thieves. Imagine a world where suddenly stealing cars becomes easier and people start getting away with it left and right.
I'm guessing more people would start stealing cars, figuring they could get away with it too, right?
Right. It seems like a free lunch at first, but what starts as a few opportunistic thieves quickly turns into a city overrun with car theft. And that low-cost, no-risk endeavor suddenly has very real consequences.
Okay, I can see the parallel to the market here. So when investors try to time the market perfectly to avoid any losses, they're like those car thieves, thinking they're smarter than the system.
Exactly. And just like with the car thieves, this behavior can create a vicious cycle.
Okay.
The more investors try to outsmart the market, the more volatile and unpredictable it becomes, leading to even more people trying to game the system. And who ends up paying the price?
The investors themselves, right?
Right.
By trying to avoid the fee, they end up with worse results.
Exactly. They end up paying a much higher price in the form of missed opportunities and underperformance.
Okay, so we've established that volatility is the price of admission for those long-term gains. But let's be real, watching your investments drop in value doesn't exactly feel like a fair fee, right? It feels more like a punch in the gut.
You're absolutely right. And that's why Housel suggests this helpful reframe. Instead of thinking about volatility as a fine, think of it as a fee.
A fee. Okay, I'm intrigued. Explain that a little more.
Well, when we think of a fine, it feels like we've done something wrong, like we're being punished, right?
Yeah.
But a fee is different. It's the price we pay for access to something valuable. Think of it like your favorite amusement park.
Ooh, okay. Let's say Disneyland.
Perfect. Those tickets aren't cheap. You're paying a hefty fee to get in, but what do you get in return?
Oh, man. I took my kids there last year, and yeah, it cost me an arm and a leg.
Yeah.
But those smiles, those memories, totally worth the price of admission.
Exactly. And that's the key shift we need to make when thinking about market volatility. It's not a punishment for doing something wrong. It's the fee we pay for the privilege of participating in a system that, over time, has created incredible wealth for those who understand the game.
So instead of freaking out about every dip and crash, we need to zoom out and remember that we're paying for the chance to be part of this incredible wealth-generating machine.
Exactly.
Volatility isn't the enemy. It's just the cost of doing business.
Precisely.
Yeah.
And reframing it as a fee can actually help us make smarter decisions.
Okay, I'm starting to see the light here. But what does all this mean for our listener, the person on the other side of this deep dive? How can they use this nothing's free idea in their own financial life? What are some concrete takeaways they can walk away with?
That's the million-dollar question, isn't it?
Well, stay tuned, because we're going to unpack that and so much more in the next part of our deep dive. Okay, so we've kind of established this idea that market volatility is like the entrance fee to this massive wealth-building theme park, right?
Right.
But how do we actually make sure we're not getting ripped off? How do we navigate this whole fee versus fine thing in a way that actually helps us reach our financial goals?
That's where things get really interesting, because it really comes down to understanding the true cost of our choices.
Okay.
Both the obvious ones and the ones that are hidden.
Okay, so it's not enough to just look at the price tag.
Right.
We need to think about those long-term consequences, the stuff that maybe isn't so obvious right away.
Exactly. Every financial decision we make has trade-offs, right? Like choosing a career path or deciding how to invest your money.
Yeah.
And those trade-offs, they always come with costs, but some are harder to spot than others.
It's kind of like playing chess, isn't it?
Yeah.
You got to think several moves ahead and try to anticipate, what could happen down the road with each decision.
Exactly.
Right? How do we actually do that in real life? Give me some practical advice.
Well, one thing you can do is whenever you're facing a financial decision, doesn't matter how big or small, just ask yourself, what am I willing to give up for this potential gain?
Okay.
Because there's no such thing as a free lunch, right?
Right.
You always have to give something up to get something else.
So if I'm thinking about, investing in this hot new tech stock that everyone's talking about,
right,
and it's, promising crazy returns, I need to be asking myself, am I okay with potentially losing a big chunk of my savings for the chance to maybe triple my money?
Exactly. Because high reward usually comes with high risk.
Yeah, for sure.
And that leads to the next important question. What risks am I actually taking on?
Okay.
Because every investment, every financial decision has some level of risk attached to it. And it's our job to understand those risks before we jump in.
All right, so let's say I'm a little more risk averse.
Okay.
I'm not looking for those moonshot investments.
Right.
I just kind of want to grow my money steadily over time. Does that mean I can completely avoid risk?
Well, unfortunately, no. There's no such thing as a completely risk-free investment.
Okay.
Even something like a savings account, which seems super safe,
Yeah.
comes with the risk of inflation eating away your purchasing power.
Right, right.
The key is to find investments that match your risk tolerance, your comfort level with, the ups and downs of the market.
So it's not about eliminating risk entirely. It's more about managing it in a smart way.
Precisely. And that's where things like diversification come in. By spreading your money across different types of assets like stocks, bonds, real estate, you can actually lower your overall risk.
Yeah.
And potentially smooth out those market swings.
Okay, that makes sense. But let's go back to those hidden prices for a second.
Okay.
What are some other costs that we might be totally overlooking when we make financial decisions?
Well, one of the biggest ones is opportunity cost.
Okay.
That's the cost of choosing one option over another.
Right.
For example, if you decide to invest your money in a rental property, you're giving up the opportunity to invest that same money in the stock market,
right,
or maybe start your own business.
Yeah.
And that missed opportunity has a cost.
It's like that saying, you can't have your cake and eat it too. Every choice kind of closes off other paths, right?
Exactly.
And those closed paths, those represent a cost, even if it's not like a direct financial one.
Exactly. And another cost that we often forget about is the cost of our own emotions.
Ooh, that's a good one.
Things like fear, greed, impatience.
Yeah.
These can all lead us to make irrational financial decisions that end up costing us big time in the long run.
Oh man, tell me about it. Remember that time I panicked and sold all my stocks during that last market crash?
Oh, yeah.
Talk about an emotional roller coaster. And guess what? I ended up buying back in later at a higher price, basically locking in my losses. Not my proudest moment.
Yeah, that's a really common mistake, and it just highlights how important it is to have a solid investment plan.
Right.
One that you can stick to even when the market's going crazy.
Right.
Because when emotions take over, logic often goes out the window.
It's true. So it's not just about understanding the numbers and the risks, but also about understanding our own psychological biases and our tendencies to make not so great decisions when we're under pressure.
Absolutely. And that's why having a financial advisor, someone who can provide objective guidance and help you stay on track even when things get rough, can be super valuable.
Okay, I'm definitely feeling a bit more equipped to handle this whole crazy financial world.
Yeah.
But I want to bring us back to that fee versus fine idea when it comes to market volatility. How do we actually make that shift in our thinking?
One helpful way to think about it is to compare volatility to the price you pay for a gym membership.
Oh, okay.
You pay a monthly fee to use the equipment and take the classes, even if you don't go every day, right?
Right.
You're paying for that access.
I like that analogy. So I'm paying my market membership fee to have access to that potential for long-term growth.
Exactly.
Even though I know there will be days, weeks, even months when the market isn't doing what I want it to do.
Exactly. And just like with that gym membership, the key is to focus on those long-term benefits.
Okay.
If you're consistent with your workouts, you'll eventually see the results you're looking for. And investing is the same way.
Right.
If you stay disciplined, stick to your plan, and ride out those market swings, you'll be well on your way to reaching your goals.
So instead of freaking out about those dips and crashes, we should see them as opportunities to buy more of our market membership at a discount.
Precisely. And like that gym membership, the more consistent you are with your market workouts, in this case, investing regularly,
right,
the more likely you are to achieve those long-term gains.
Okay, this whole fee versus fine thing, it's really starting to make sense to me.
Yeah.
But I feel like there's even more to unpack here. What other wisdom does Housel offer to help us really embrace this concept?
Well, that's where we get into some even more fascinating stuff.
Okay, so we've talked about reframing volatility as a fee.
Right.
And, thinking about those hidden costs of our financial decisions.
Right.
But what else can we do to really internalize this whole nothing's free idea, make it part of how we think?
Well, one powerful thing you can do is actually cultivate gratitude for what you already have.
Okay.
It's so easy to get caught up in wanting more, always chasing that next financial goalpost.
Right.
But if you take the time to really appreciate your current situation, even if it's not perfect, it can really change your perspective.
Yeah, it's like that saying, comparison's a thief of joy, right?
Exactly.
We're always seeing those perfect-looking lives on social media, the fancy vacations, the expensive cars.
Right.
And it's easy to feel like, oh, falling behind, got to keep up with the Joneses.
Exactly. And that kind of thinking can be dangerous, you know?
Yeah.
It can make you feel like you're always chasing something that's just out of reach.
Right.
But when you shift your focus to what you're grateful for, it changes everything.
Okay.
Those fees you're paying to reach your goals, they don't feel like such a burden anymore. They feel like an investment in a future you're excited about.
So instead of focusing on what we don't have, we got to appreciate what we do have.
Right.
It's about finding, like, contentment in the journey, not just focusing on the destination. And you know what? I think that really ties back to Housel's main point in nothing's free. It's not just about the financial costs. It's about the emotional and psychological costs too, right?
Absolutely. And when you find that balance, when you appreciate the present while still working towards a better future, that's when you unlock the real power of this nothing's free idea.
Okay, I'm feeling inspired, but before we wrap up this deep dive, I got to ask you one last question.
Okay.
What's like the biggest takeaway you hope our listener walks away with today?
Oh, that's a great question.
What's that one piece of wisdom that can help them navigate their financial journey with more confidence, more clarity?
I think the most important thing is to remember that real wealth isn't just about how much money you have.
Okay.
It's about having the freedom to live a life that's meaningful, that's fulfilling.
Yeah.
A life that aligns with your values, your priorities.
So it's not about like chasing riches just for the sake of being rich. It's more about using money as a tool to create a life we love.
Exactly. And that's where understanding the true cost of things comes in. When you're aware of the trade-offs, when you're willing to pay the price for what really matters to you, that's when you achieve a level of wealth that goes beyond just numbers on a spreadsheet.
Well said. I think it's time to wrap up this deep dive into nothing's free. I don't know about you, but I'm feeling pretty empowered.
Me too.
To face those financial fees head on, knowing that they're not punishments, they're investments in a future I'm excited to build.
Exactly.
So as you go about your week, I want you to think about those hidden prices in your own life. You know, what are you willing to pay to achieve your dreams?
Yeah.
And are you looking at those costs as fines or as fees? Something to think about. Until next time, happy investing.